Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Welcome to Investing the Templeton Way podcast. I'm your host, Lauren Templeton, and I have my co-host with me here today, Scott Phillips.
Hello, everyone.
And we have an exciting guest, Chris Davis from Davis Advisors. As many of you know, Chris comes from a lineage of very successful investors, beginning with his grandfather, who was investing in the 1940s and the 1950s. Chris is a portfolio manager at Davis Advisors, a firm started by his father in the 1960s. Chris is also a director of a small company that some of you might have heard of called the Coca-Cola Company. He is well respected in the field of value investing and is generous enough to join us today. So welcome, Chris.
Thank you, Lauren. I'm so glad to be here.
Yeah. So the last time I saw you, I believe we were waiting for a bus in Richmond, Virginia to go to the Markel AGM.
That is exactly right. And it's funny, I'll mention as an aside, I'm also a director of another small company, Berkshire Hathaway. And of course, seeing Markel and going to that meeting together, I was reminded of the fact that I actually first met the management team of Markel in Omaha in something like 1990. We were both out attending the Berkshire Hathaway meeting, and Steve Markel and Tom Gaynor were there, and we happened to be sitting next to each other in the Orpheum Theater.
How cool is that? That's a really neat memory. I'm a director of Fairfax Financial, so those three companies have a lot in common, and it certainly is a fun network. We like to start most of these interviews with a little bit of background, and yours really stands out to me, Chris. You represent the third generation of a highly successful family of investors. But what's really fascinating to me is that all three generations have really done it themselves. I mean, you were the beneficiary of joining a very well-established firm, but you've had a long career of beating the market. And I'm just curious, how did that happen? Is this just some superhuman investing DNA that you guys have, or does it speak to a family culture and set of values that's being passed down?
Well, I think that values and perspective are certainly part of it. I think the most important part is that both my grandfather and my father loved the investing game. And they brought that energy. I used to go to the train station to meet my dad's train when he was coming back commuting from the city. And you would see all these gray men. They were almost entirely men then, getting off the train looking just beaten. I mean, it was just, it was, and my dad would sort of spring off. And my grandfather was the same way. They loved this puzzle of investing. They loved this idea, as my father once said, that he was always living in the future. He was always studying success. And very early, they brought home the idea that in successful investing is really about understanding businesses, and businesses are really people and ideas. And so I never saw it as this dry, analytical sort of system of pure sort of securities analysis and securities research, but instead I saw it as this sort of you were almost studying history in real time, history in the making. And So even from a young age, there was this sense that there was something exciting about investing. And when I would watch that train and everybody get off, I thought, well, all these other people must be lawyers.
Yeah.
It never occurred to me that there could be other people in this profession that somehow were beaten down by it. And so I think they gave that spirit of sort of excitement and curiosity, and that's what was really contagious, much more so than any particular code book of what it is to be able to find successful investments.
Yeah, that reminds me so much of John Templeton. His enthusiasm for studying investments was contagious. Scott will tell you, or he can tell you right now, about his first introduction to John Templeton. And Uncle John asked Scott what he did for a living. And Scott said, "I'm an analyst." And Uncle John said,
I'm an analyst too.
it was just an enthusiasm for learning about businesses. I've read somewhere, or maybe I heard in a podcast that you participated in, that you also have a great affinity for stock certificates. So, can you say a word about why you like stock certificates? And I find this very interesting because my listeners will know when I was a child, my dad would allow me to pick one stock per month. And we would hang the stock certificate on the wall of my room. So my room was wallpapered in stock certificates. And that's a cute story, but it was really important to me because that stock certificate represented tangible ownership in a business. So I understood I was buying a portion of a business. What do you like about stock certificates?
Well, like an old comic book collection in the attic, I suggest you find that wallpaper. There could be things very valuable in there. I have a stock certificate, one share of Berkshire Hathaway that I bought a long time ago and put in a frame. And I realize now that's like a Monet hanging on the wall, and maybe I should have a security guard stand next to it. Um,
Absolutely.
but, it's interesting. You're right about they sort of have this tangible connection, but I had a much more prosaic reason for getting stock certificates. One of the hallmarks of our culture at our firm was really based on the idea that you can't learn from mistakes if you don't admit to them. And the nature of investment management is a lot of people trying to convince clients that they're infallible, that they're experts, that they're geniuses. And so it's a culture, what I found it, even at other firms that I worked at, where, success has a thousand fathers and failure is an orphan. And so it became whenever there was one particular place I worked, I found that my boss, it was always somebody else's fault when there was a mistake. It was the company had lied, or the analyst had done a bad job, or, some other reason. And the result was that cumulatively at this firm, there was very little learning. And so when I came into Davis Advisors and I first started as a manager of a financial fund that I started in 1989, but then as I rose and managed the research team, and I became very obsessed with the idea that we really have to study mistakes. We have to study failure. We have to study what went wrong. They do that in every other industry. You think when an airplane crashes, the amount of experts that go in to try to figure out what went wrong. And that's
Sure.
one of the reasons that flying is so safe. So we wanted to build a culture where we studied mistakes. And I thought, well, the best way to do that, sometimes is to have powerful symbols. So I said, every time we make an important investment mistake, and Lauren and Scott, we could really dive into what we mean by mistakes, because obviously we don't just mean stocks that go down. Every stock you buy is going to trade lower than the price you paid for it at some point in the future, almost certainly. And so having a stock trade below its purchase price is not a sign of a mistake. So we can talk a little bit about what that is. But I said the most important symbol we can do is let's frame the stock certificates of our biggest mistakes and hang them on the wall in the middle of the research team. And on the bottom of each mistake, let's put a plaque that codifies the transferable lesson
Oh,
learned from that investment mistake. And My children like to tease me and say, "Well, that wall has become more of a mural," because of course it's cumulative, and there are probably 20 or 25 certificates on that. But of course, realizing that almost any stock could end up on the mistake wall, I very early in my career, I all of my money by and large is invested in my funds alongside clients. I haven't purchased individual stocks in decades. I think it's better just to be invested alongside your clients. But I made an exception very early when I had this idea of the mistake wall, and I went out and I bought one share of every company in the S&P 500. And there, those certificates lie in wait for when they may end up, unfortunately, on the mistake wall.
I love that, and I would love to see your mistake wall one day.
Yeah, Chris, it brings up an interesting question in the post-mortem kind of analysis of mistakes and successes even. It uncovers something unique, I think, to investing, which is that great decisions can have bad outcomes and poor decisions can have good outcomes. How do you parse out the difference between circumstance and skill when you go through those
God,
analyses?
Scott, you're exactly right. And in a way, that's what I was alluding to. It's process versus outcome. I don't, I'm sure he wouldn't mind my telling the story. I was talking to Warren Buffett once about this idea of having a permanent loss of capital, which is, you think, almost the definition of a mistake in investing. And he sort of corrected me and he said, well, look, take out a coin from your pocket. He said, I'll bet you $1 billion on a coin toss if you give me 2 to 1 odds. Now, as you think about that, what that means is that there's a 50% chance of losing a billion. Now, for me, that would be catastrophic. Uh, but of course, the nature of when you think about, communications theory and you go back to this idea of how much you weight different probabilities, the key is not to be is the combination of knowing the probabilities of success or failure and then knowing what percentage of your portfolio it is rational to allocate based on that probability. Of course, the answer is never 100%, right? And this was Claude Shannon's. Originally, it was his theory of that applied to Bell Labs and communications theory, but of course, it was transposed into things like beating the house and blackjack betting. When you have a small edge, how much do you bet as a percentage of your bankroll? So, in that case of the coin toss, if you were betting 4% or 5% of your portfolio on a coin toss where you had 2 to 1 odds, that would be a very rational decision, even though there's a 50% chance of losing 100% of your investment. And so that is a good sort of distillation of the idea of process versus outcome. So, Scott, getting to your question, when we look at that wall, I would give you some broad categories of mistakes. There are mistakes of what I'll call judgment, and there are mistakes of process. There are mistakes where we happened to make a lot of money. So we have one stock on the wall where we made tenfold on our money. So why the hell would it be on the mistake wall? And I like to say, well, if you were playing blackjack and you had a 20 and you asked for a hit and you got an ace and people patted you on the back and said that was brilliant. Of course, it was moronic. You were an idiot. You made a terrible mistake asking for a hit when you had a 20, but you got lucky and luck
Mhm.
bailed you out. And we, of course, have some investments like that, not many, but where we made a lot of money, but it was still, there was a mistake in the process. So those, and then the last sort of series of categories I'd give on that mistake well are mistakes of omission versus mistakes of commission, right? So there are companies that we owned that we ought not to have owned, and of course there are companies that we did not own that we ought to have owned. And again, it's not because they went up a lot and we didn't own them. It's because They were in our wheelhouse. We analyzed them. There was something in our analytical process that failed to appropriately weight a foreseeable outcome. And it ended up we passed on something that was monstrously successful, but that within our process we could have identified. So that if I give you those all those sorts of broad categories, I'm happy to spend the whole rest of our conversation on that wall because I think it's interesting and we can talk about, buying wrong, selling wrong. We can talk about psychological factors, behavioral biases versus analytical mistakes where, can think of simply, companies where there was evidence in a cash flow from investing section that we underweighted because, back in my early days, we were so focused on just the cash from operations and the income statement. Investing that sounded like purely a finance function. It didn't seem like it would be so important, but that's where a lot of companies hid things like vendor financing and some other types of things or did partial spin-offs. And anyway, we can spend as much time on it as you like because it is one of my favorite subjects. I always thought I never will, but I always thought if I ever taught a course, I would just like it to be, 20 weeks of going down each of those stock certificates.
Oh, you should do that. I would take your course for sure.
Well,
What you're really
now I've got one.
yeah, one student. What you're really describing is you're building a corporate culture at Davis Advisors where you do analyze and pay a lot of attention to your mistakes. I'm very fascinated with culture and how important culture is. And I'll tell you one of the reasons is because prior to joining Fairfax Financial as an independent director, I would have answered the question, how important is corporate culture? I would have said, yeah, it's important. But I don't think I really believed it until I came on as an independent director at Fairfax and saw what a really strong corporate culture, the influence that it plays just on every decision and how profound that effect can really be. How important do you think corporate culture is? And how is it determined? How do you look for it in a company that you invest in? And can you give me any examples that come to mind?
Sure. Well, the old saying is culture eats strategy for breakfast. And it's absolutely right. It's especially true, Lauren, at a company like Fairfax or Berkshire, Markel, any investment firm, it's even more important. And I'll give you a good example. Understanding culture and how it manifests in the business is, I think, one of the reasons that companies like GE failed so dramatically in the financial services arena. Now, what I mean by that is if you think about rules of typical businesses, in a business, you manufacture a product, you sell it to a customer, you measure your success on profits. Right. And so you think about a GE culture that says we want to be number one or number two. We want to outgrow all of if the industry is growing, 7%, we want to grow 10 because we want to gain market share. We measure our success, whether we're beating our competitors in growth, whether we can sell more and so on. Now, in a profession, you're providing a service to a client and you can't measure success by profits. You need to reference client outcomes. Now, what I mean by that is you think about a doctor. If you want to tell who the best doctor is, their tax return may not be the best indicator. You would have to look at patient outcomes. You have to look at student outcomes for teachers and so on. So in investing, in a lot of financial services, profits are not necessarily a good measure of whether you're delivering value to the end client. So a typical business culture, when it comes into a profession, often leads to a cesspool. Now, I'm going to use that as an analogy for what I'm getting to with corporate culture, and particularly at a company like Fairfax or financial services. So you think about when GE got into the insurance business, like Fairfax is, like Markel is, like Berkshire is, and you bring that GE competitive culture in where you measure success by growth and profits. And of course, what we know in insurance is you can grow at any rate you choose by underpricing your product, right? In other words, if somebody goes out and offers you car insurance for $100 a year or health insurance for $100 a year, they are going to be the highest growth company in those industries. And of course, they'll be destroying value. So in a financial services firm, and in particularly in a firm that where the cost of goods sold is a mystery when you sell the product, it's an assumption, it's an estimate, but it's not known. Culture becomes absolutely paramount because you have to have a culture that is willing to walk away, is willing to shrink, is willing to lose market share. Then you have to have a culture that is willing to be aggressive and move in just when everybody else is running out.
Mhm.
Well, that is such a different type of corporate culture than you have in a typical corporate environment. So I would say culture is important everywhere. It's important in every business. And we can go model through model, whether it's a chemical company, whether it's a healthcare company, whether it's a pharmaceutical company. Do they have a research culture? Do they have a marketing culture? Do they have a safety culture? What are the natures? Are they overly paternalistic or protectionist? Are they overly cutthroat? And there's no answer to what is the perfect culture. It's important that that culture be identifiable and sort of reinforceable. It's very hard to change, but as you say, at a company like Fairfax, at a company like Berkshire, at any company that is involved in generally in the type of financial services that involves issuing credit or assuming reserve or liability risk in the case of insurance, that culture is especially peculiar because it really has to have this mindset of being willing to act completely different than every other company in the industry. And so I would say that part of our long history in financial services, which really goes all the way back to the 40s, our interest in financial services has been because culture is something that doesn't show up on a screen. Culture is something that is not well analyzed. And so in an industry like insurance, it's the sort of thing that can create a durable competitive advantage and yet still never really be appreciated by Wall Street because it doesn't show up on a screen. I'll give you one example that I think is so powerful that this is way out of date, but it still holds true is that when I started, there were two companies in Ohio, headquartered almost in the same town, selling almost the same products, both the products which were publicly filed, and therefore there was no secret on pricing or terms or conditions. And they had roughly the same market cap. And this was Ohio Casualty and Progressive. And somehow for the next, I think it was 2 decades, Progressive grew at 21% a year and Ohio Casualty grew at something like 6. Well, isn't that incredible that you could be in the same industry, selling the same regulated products, headquartered almost in the same town. They were about 50 miles apart, and still have a difference of 15 or 1600 basis points per year for 2 decades.
Yeah.
And what's the answer? Well, of course, it's culture. There's nothing else. They had no other competitive advantage. They didn't have a particularly better brand. They didn't sell their products through a different distribution channel. It was just a deep, deep difference in culture.
I love that progressive story, and I thought you might pull that one out. Do you wanna tell a little bit about the CEO of Progressive and how he signs off on his annual reports, et cetera?
Well, Peter Lewis was one of the great executives of all time. It was a family business. He took over from his father. His brother died in a car accident at quite a young age. And Peter, who was really, I mean, it's amazing how often a great entrepreneur, you meet them and you think they never could have risen at a traditional company.
Mhm.
I often picture, what if Warren Buffett worked at, Exxon or something like that. It just that quirk, that independence of thought. And Peter Lewis was like that in the extreme. He was, in some ways, sort of a flower child. He signed his annual report, Peace, Love, and Joy, every year. He had a crazy collection of contemporary art that he would always fill the annual report with, but he would write his own letters. And I think in part because of the death of his brother, he really felt that the mission of that organization was to reduce the trauma of car accidents. And some of that is, of course, financial, and some of it is emotional. And how do we in a sense change this industry? And he was spectacular. And I think I could tell this story. I don't think it's wildly out of school. Back in the early days before the internet, firms like ours, when we're trying to do research, I love that, John and Scott both describe themselves as analysts, research analysts.
Yeah.
People, when they ask me what I do, I always say I do research. Like, if a cab driver asks me, I mean, because if I say I'm at Wall Street, that gives a totally different impression of what I do, how I
Yes.
spend my day. And at certain times of certain cycles, it might get you cash, kicked out to the curb. Uh, but I think of what we do as, I think of my day-to-day activities as research, and then our firm as fundamentally in the stewardship profession. People
Mhm.
trust us with their savings. But anyway, uh, going back to Peter, we and the idea of doing research. In those days, we had what was called a clipping service, and this was where you would pay a firm that would subscribe to all different newspapers all around the world. And you would give them a list of companies or topics that are of interest, and then they would read all those newspapers and clip the articles out. And of course, they had some economies of scale because they might have clients that were interested in, they could have one person read one paper, but maybe serve 6 different topics or 10 different topics. So clipping services were quite popular back then. And I had a member of our team came into my office and he said, well, we just got some news back from a clipping service from a news report in New Zealand. And I
Hmm.
said, well, what's that? He said, well, it appears Peter Lewis was arrested in New Zealand for having a significant amount of marijuana.
Oh.
And, in those days, that was quite frowned upon. And he said, but, there's bad news, good news, and bad news about this story.
Okay.
And I said, all right, well, what's the bad news? He said, well, of course, the bad news is that CEO of one of our holdings was arrested for marijuana possession, and it was quite a lot of marijuana. And I said, well, my God, what's the good news? He said, well, the good news is the judge let him off. And I said, well, that is good. Then what's the bad news? He said, well, the bad news is the judge let him off because he was convinced it was solely for his personal consumption.
Oh my goodness.
But of course, like everything, Peter was in the vanguard, and he actually smoked marijuana back then, partly as a pain palliative. He had diabetes and ended up actually as an amputee, and so he was in the vanguard as usual in
Yeah.
predicting societal trends that were decades in the future. But I always love to tell that story because he was
Yeah.
such an iconic and iconoclastic leader. And really, he built a culture based on analysis, based on drive, based on being really different. And what a job they've done.
Yeah, that is a very interesting story. And there are so many neat people you come across in the investment industry. I love the idea of Progressive being a mission based business. And I think, a lot of great entrepreneurs see their businesses that way, that it is very mission based. You can do well and do good all at the same time. I know that Prem Watts at Fairfax sees that the same way. I think it's really interesting when I was studying for this podcast and going over your background that you have a graduate degree in theology. Is that correct?
Yes, yes. I actually have a joint degree in both philosophy and theology from 2 different colleges at the University of St. Andrews.
My dad has a degree in philosophy. He says he's still trying to figure out who will pay him for it.
My father was he liked that it was a joint degree. He said, in investing, you'll need both those degrees. You'll need to have an investment philosophy, but then you'll need to pray like hell.
Yeah. Well, Uncle John did pray before his meetings at Templeton, and people say, Was John Templeton praying for the stocks to go up? And we're like, no, not at all. We're praying for wisdom and to set the tone of the meeting, working for, as a team, all of those things. And the Templeton Foundation, we still do pray before every meeting. But it seems like you weren't really predestined to go into the investment industry and that it really took a dramatic change. What happened? What convinced you to follow
Well,
your grandfather and father's footsteps?
it was interesting. I had worked in summer jobs all through my childhood, and a lot of those jobs were working, with my father at my grandfather's firm. They had separate operations, and of course, as I said in the beginning, it was clear that they loved what they did, and I loved visiting companies with them and this idea of studying success and so on. But my real interest through college was partly in the idea of being an analyst, but more like an intelligence analyst. I loved the idea of studying countries. I thought, wouldn't that be amazing to be the greatest expert on Czechoslovakia, to know the literature, the history, the families, the language, and to use that information to try to make predictions about how things that would unfold in a way that would serve our country. And needless to say, I think I was not cut out for the CIA mold. I had no interest in being a spy, but I loved the idea of being an analyst. I thought that was exciting. And so the philosophy, that was a big part of that, was just the breadth of studying logic and metaphysics and, this sort of these big questions. But as theology unfolded for me, one of the things I was really struck by, because I don't think of myself as a deeply faithful person, but I'm a lover of the Episcopal Church. And one of the reasons is I'm so struck as I thought about communities where the church plays a central role, how often in history those communities have better outcomes. As I looked at things like social work, I was so struck by this culture of social work which tells people that they're victims. And it had this was particularly in the 70s, this sort of mindset of people as victims. And of course, the theological perspective is people are creations.
Mhm.
People have this enormous opportunity to take responsibility for their lives and to recognize that they're loved. And so I was originally interested in the church almost as a vehicle of social work and social improvement. And I went to work for the Episcopal Church as a pastoral assistant at the American Cathedral in Paris. And it was a glorious year, and I had a wonderful, wonderful boss. The dean of that cathedral, named James Leo, was just one of the great men. And at the end of my time, then he really said, loving the church and wanting to help people are different things. And he said, imagine wanting to be a veterinarian and thinking that because you love animals, you would be a good veterinarian. Well, of
Mhm.
course, being a veterinarian is very different than just loving animals. Right? You
Yes.
have to you have to have a whole different range of interests, and of course, you've got to manage owners and all of that. So I had the same sort of recognition. So I had wanted, I'd thought about research in terms of government service. Thought about theology in terms of social work and helping people's lives. And in a funny way, coming into when I moved back to the States and I started thinking about my career, what I was really struck by is how there's a way of conceptualizing what we do investing as combining both of those things.
Yeah.
Obviously, the research part is just baked in. You're studying success and motivations, and you're trying to make predictions about the future. The latter part came to me a little bit later, and it was driven by our mutual friend, Lauren Tom Gaynor.
Mm.
I mentioned being in Omaha with them in the early 90s. It may have even been the late 80s. I think it was the early 90s. They'd only been public a year or so. And I used to make a joke to my friends who had gone on in seminary that I had chosen a low calling by going to work in the investment business. I used to
Mhm.
say, well, it's not a high calling, but it's very interesting. And I made that joke to Tom Gaynor. And Tom stopped me, and with absolute, he's always full of good humor, but this was a deadly serious moment. He stopped me and he said, "Chris, stewardship is a biblical profession.
Mhm.
It is a biblical profession." And that was a when I think of the changes, the turning points in my life, that conversation stands out as one of the most important turning points in my life. Realizing how deeply the notion of stewardship should be baked into what we do every day. And it was incredibly energizing, and a little bit like Peter Lewis and Progressive. It really changed the mindset, not just for what I do, but it helped change the mindset of the firm. And over time, we went from people that were only interested in basis points to people that really recognized that what we do has life-changing consequences for the people that have entrusted us with their savings. And whether they send a kid to college, or whether they can afford their retirement, or whether they can pursue their philanthropic interests, or whatever it is, that's really at the core why we come to work. And over the course of decades, it's made the culture of this place something that I'm so proud of. And it means I work with people that I admire, that I respect, and that really care. And going back to really what you said about entrepreneurs, I think it's not just that they're mission driven. I think that's become a piece of jargon that can be a little bit maddening. But I think what it is just they really, really care. And I'll
Mhm.
tell you, when you go to a big bureaucratic Fortune 500 company, or when you go to the post office, you think, or the DMV, you think of how rare it is to find somebody that really cares about the job that they do, and how delightful it is when you do.
Yes.
And so it's not just delightful for you as a customer, it's just they're happier. They care about what they do, they care about doing a good job. And so anyway, what a long answer to your question, but
Well, I
but
love it. It reminds me so much of John Templeton and his views on serving others. And so many little stories over the years. I can remember being in a hotel in Clemson, South Carolina, and it was like a Holiday Inn. We went to check in, and the guy at the front desk said, "Oh, your last name is Templeton. Well, you're not related to John Templeton." I said, "Well, I am." He said, "Well, when you see him, you thank him because of him, I sent my kids and my grandkids to college."
oh, I
And
love
just went
those.
on and on. And I had chills all over my body
Yeah.
because that is how Uncle John viewed his role, and he did take stewardship so seriously. And it just made this huge impact on me that really we're here to serve our clients. And it was very touching.
Absolutely. I mean, this whole conversation has really just there's a lot that we could dive into. But one of the things that goes along with stewardship, and we've kind of addressed this somewhat with Progressive and Peter Lewis, is this concept that's somewhat been lost over time, which is that really in the free enterprise system, when you have a strong leader on a mission who wants to improve someone's life, with a better product, or, you talked about the property and casualty insurance aspect. That is a form, it's a very powerful force in society. And it really harkens back to the Ben Franklin idea of doing well by doing good. And I think that for some reason today, some of that's been lost, just how much good for society can be promulgated through the free enterprise system. So I guess my question out of that long statement, Chris, is when you're looking at a company, is that part of the calculus? Do you look for other stewards out in the market trying to do the same thing?
Well, I Scott, it's such a good question. I had a brilliant, brilliant theology professor named James White. He went on and became the moderator of the Church of Scotland, which in typical Scottish form is what they call the head of the church, but they call him the moderator. Isn't that wonderful? And I don't know if you remember, there was a movement in the 80s to create this thing, Hands Across America. And on a
Hmm.
given day, they were going to try to create a chain of people all the way across the country. And in Scotland, where I was living at the time, they decided to do Hands Across Scotland. And the sub hashtag, if we wouldn't have called it that then, but was show the world you care. And my professor was so disgusted by this idea, show the world you care. It's really about, of course, what we now call virtue signaling. It
Mhm.
wasn't about doing good. All these people standing out there in the fields, for God's sakes, go to a soup kitchen, go help, go do something, show the world you care. What a vain enterprise. Well, in my view, what a very basic line of fundamental common sense, common decency premises evolved into in the ESG industry was exactly that sort of abomination,
Yeah.
where it really became about signaling, about marketing, not at all about having a positive net change. So I actually wrote a memo about this that succeeded in annoying everybody, which is why I thought maybe it's right.
Yeah. It's always a good sign.
People on both sides hated it. But the idea is this: as long-term investors, if we're going to own a company theoretically forever, right? That's our mindset when we buy it. Our return is going to be driven by the returns of the underlying business far more than any change in the relative valuation of that business. So it's really going to be about the earnings of the business. Now, when you look at that over a long time frame and you say we're putting up X dollars, our return is going to be the dollars the business generates that are allocated to us as owners over time, then one word jumps right to the top of the page: sustainability. Are the earnings that we have modeled for this business sustainable?
Mhm.
Now, let's go down to the next level. Say, well, what do you mean by sustainable? Well, we'd say, well, if the business suffers enormous competitive setbacks, those earnings might not be sustainable. So think of competitive analysis. The business may suffer disruption, so technological destruction of that sustainability. But a very, very common one, you just have to look over history, is that if the company generates its profits in a way that is at the expense of employees, regulators, customers, the environment, you name it. In other words, if I use the philosophical term, if the company generates profits in a way that detract social utility, all of history has shown us that society then demands compensation.
Yeah.
And that demand can come in the form of regulation, taxation, litigation, disruption, right? So, GE polluting the Hudson, it did not work out so well. It may have worked out great for decades, but it did not work out over the fullness of time. Chainsaw Al treating his employees as if they were completely expendable, inhuman sort of cogs. It didn't work out so well for Chainsaw Al. Companies playing fast and loose with regulations, with pollution, and so on. So the dirty, dirty underbelly and the untested assumption of ESG is that somehow capitalism is a zero-sum game.
Mhm.
That if shareholders make money, it must be at the expense of another constituency. And that is just not true,
Yep.
right? It is the whole history. You read Adam Smith, right? You know, the whole history is that the nature of capitalism is that companies tend to succeed by offering something better to their customers, by treating their workers well. And so optimizing shareholder value is exactly the right strategy with one important provision: to reconcile the optimization of shareholder value to long-term social utility, as outlined by the ESG movement, multiple constituencies, and so on. Those reconcile if you stretch out time horizon. So if
Mhm.
every investor was required to own any business they invested in for 20 years, the ESG movement would disappear, because all of the exploitative opportunities that companies can take to maximize shareholder value at the expense of another constituency. All of those are short-term strategies that where the bill comes due in the fullness of time.
Yeah.
And so to me, what we have done as investors for 50 years has always been centered on the idea of sustainability.
Mhm.
And the idea that it is some new overlay is just marketing hype. And so we don't have exclusionists. We often say, you know, big companies in legacy industries can do more to improve the world by improving their behavior. So
Mhm.
engagement can really matter. You think about and the idea that U.S. natural gas fracking should be banned. Well, if energy demand stays constant, then that energy supply will simply come from things like Nigeria. Uh, so I think people don't want to think through the true complexity, the true messiness. They just want to feel good. They want to, as my professor said, they want to show the world they care. And I think that is an awful, awful outcome. And I think long term investing and what I'll call a prioritization on all of the constituencies that are involved in creating shareholder value, I think those are completely aligned over the fullness of time.
Yeah, we tend to agree with you on ESG and really all of those comments. One time gave a speech to a bunch of high schoolers called the morality of profits.
Yeah.
And so much of what you said, I tried to demonstrate in the speech, not as eloquently as you just said it, but I tried to get the point across to the students that
I like that you substitute eloquence for long-windedness.
no, no, it was good, and I like the point on time horizon, right? So much, is dependent on time horizon,
Yeah,
and I even think about the way our government spends money, right? It's a question about time horizon, what's
yeah.
best in the long term, and, I think that everybody's so used to thinking short term. It's clear that you take your role of financial stewardship really seriously, and it seems to permeate through your views on risk, return, capital allocation. And Chris, the last several years have not rewarded that approach as we've been through years of low interest rates and speculation. Where are we today? And is it over? Do you still see excesses in the system?
I think it is over. Throughout all of human history, we have a chart that, believe it or not, goes back 3,000 years. I think the first few data points are a little sketchy, but it talks about interest rates. And the way to think of interest rates are the cost that a holder of an asset of money charges for somebody that wants to use that money. So the user of the money might be a borrower, they might be a corporation, it might be a government, it might be an individual, but they are asking, may I use your money for some period of time? Now, the person who gives them that money, whether it's the form of an equity investment or a loan, foregoes the opportunity to employ that capital themselves. So they charge for that. And over all of human history, there has been a charge for using somebody else's money. So to understand just how extreme the environment that we've been in since the financial crisis, the distortion that was created by the idea that never before in human history, going back, as I said, we have this chart that goes back 3,000 years, where was the cost of using somebody else's money reduced nearly to zero. And the distortions that had such a huge impact on the world and on markets in particular, because what it did is it meant that remote earnings no longer had to be valued at less than current earnings. So the prospect of huge, giant earnings in the future ended up being discounted at such a low rate that they became worth a lot today, even though, the time value of money is sort of a fundamental concept, sort of like gravity. It provided free capital to disruptors. It rewarded high leverage. And so it rewarded, I think there were 70 companies in the S&P 500 trading at more than 10 times sales
Oh, yes.
at the peak.
Listen, we counted 700 and how many?
It was 718. Now that's across all listings
Yeah,
All listings
yeah.
in the
trading at more
US.
than 20 times sales.
Isn't that
And this was,
unbelievable?
when was
This
this?
was at the beginning of 2021, maybe
Well,
January.
if you haven't seen it, you guys, Scott McNeely gave a talk
Oh, yeah.
in 2003. Did you ever see that about
I've got a copy of
it's
a
so good.
quote that he gave. It's so good.
Where he
And
it sort
I
of said, "What
actually,
were you thinking?"
yes,
You know?
I have that in my desk drawer actually right now. Like I could get it out and read it to you because I use it in so many talks. And if you don't mind, I will read it because
Oh,
that way
do.
our shareholders can hear it.
Yeah.
So Scott McNeely, the CEO of Sun Microsystems, famously said following Sun stock, which had run up $64 a share before falling to $10 a share a year later during the dot-com bubble. Here's the quote: at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 10 times revenue? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need footnotes. What were you thinking?
Oh, what a fab. I just love that you had that in your drawer. It's so perfect. And at the same time that that mania is getting fed, the types of businesses that we own are getting penalized. Right? Because in a way, a big part of our portfolio are in business models that have been around since biblical times, making a spread on money, right? It's one of the oldest professions in the world. Well, if interest rates are near zero, being the value of float approaches zero. The spreads that you can make between deposits and loans approaches zero. So we owned businesses in financial services that were absolutely penalized by this crazy environment. We own businesses that are conservatively financed. We own businesses where we tend to place a much higher value on earnings near in because we use a discount rate, let's say 10%, discounting earnings back to the present. So we would have valuations that would be far different than what the market was placing on those businesses relative to the rest. So we've been in an environment for a decade. And by the way, I do not fault the Fed for having aggressively taken action during the financial crisis or even during COVID. It's really that they became addicted to those policies and they way, way, way overplayed them. And that's what created this massive asset bubble. And so, in a sense, it helped the sorts of businesses we don't own. It really hurt the businesses we do own. And so our feeling is now that that jig is up. I don't know how it will play out exactly, but I do know that this feels more like a return to normalcy, right? In other words, people view this as, oh my God, we're going into a bear market. We view it as, oh, thank God, rationality is returning. And there was, all of the crypto, NFTs, unicorns, SPACs, all of that stuff. Commercial real estate with 3% cap rates, 2% cap rates. You think of the risk that you're taking. To us, it was just a world where what we did was so far out of sync that it just looked like it didn't work. And it was a long time. I mean, what happened in the last, really from the financial crisis. We have a wonderful chart, Lauren, that we take our top 15 holdings and we show their earnings progression over the last decade. And it is this wonderful line up and to the right. And I always say, if that was a portfolio of well located apartment buildings, you'd look at that and say, wow, the earnings are up a couple of 100% over a decade, that must have worked out quite well. And then we superimpose on that the valuation that the market has placed on those earnings. And let's say when we bought them, it was about a 7% earnings yield, maybe a little bit lower, 6.5, 7. So we started with a 7% earnings yield. It's up 2.5 fold. So you would think, wow, our cash yield on those investments now must be around 15%. That looks pretty good. And yet, the valuation of those companies has fallen from like 15 and a half to something like 9 during that same period.
Wow.
And so, when we say that in the short term, the market's a voting machine, and the long term, it's a weighing machine,
Yeah.
what's amazing is for the last decade, the weighing machine was broken. The change in the valuation so far sort of swamped the improvement in the business. And now we feel like that is big. That return to normalcy is what's beginning to happen. And as I say, we're not speculators. We just think that's common sense, that the businesses that are durable, that have produced those sorts of words: durability, sustainability, profitability, expense discipline, capital discipline. I was talking to some folks at Facebook, and they were saying, God, it's outrageous how entitled our culture is. I mean, these people. I'm like, well, that's like parents complaining about how spoiled their children are. Who do you think did that? And so, I think we're beginning to see a movement back to sanity. And so we really are we feel so much more comfortable now than we did a year ago when prices were 20 or 30% higher.
And kind of building upon that, Chris, towards the end of that cycle, when the valuations were so extreme in the U.S., you alluded to this, the valuations, because I know you're a global investor, the valuations internationally were pretty stagnant. And so those discrepancies were extraordinarily wide. Do you see opportunities overseas? I mean, I know they have their own issues, internationally speaking. There's a lot going on there too. But what do you see when you look around the world?
Well, money doesn't care where it's earned or what business it's earned in. You had these huge discrepancies between dollars earned in, traditional, what I'll call value industries in the US, and then so-called growth companies. And as if somehow a growth dollar is different than a value dollar. They're both dollars. And so you had this crazy distinction between growth and what I would really call speculative growth versus durable or even growing value. So that gap was one big characteristic of the market over the last decade. But Scott, you're exactly right. The other big characteristic is people just decided a dollar earned in the US was worth a lot more than a dollar earned outside the US. So the relative valuations of so-called value companies in the US fell dramatically relative to growth. But then the relative valuation of companies who are headquartered outside the US fell dramatically relative to companies headquartered inside the US. So I absolutely agree with you. As a family, we I guess this goes all the way back to the 90s. In the 90s, we for each analyst, we eliminated geography as a relevant factor in their developing industry expertise. If you are going to be an extra expert on the beverage industry, you should study Anheuser-Busch and Miller, but you should also study Heineken, and you should study Molson, and you should study FEMSA, and you should study South American breweries and Brahma. And because the beer industry was global, the beverage industry was global. And sure enough, all of the American beer companies of size were bought by foreign companies, two of whom were emerging markets companies. And now, of course, they've consolidated into one. So the Brazilians bought Anheuser-Busch, the South Africans bought Miller, and then the Brazilians bought Miller. So we've had that as a big part of our culture. If you're going to, a customer doesn't care particularly if the product was made in Detroit, if it was made in Japan, if it was made in Mexico, if it was made in China, and so on. So we had this geographic mindset, this global mindset. We started offering that to clients about 10 or 15 years ago. in a separate global and international strategy. And then I would say our family has been building our position in those every year, including most dramatically in the last couple of years, because that does seem like a huge disconnect to us.
Mhm.
I do agree with your sort of illusion that there are a lot of caveats. Right? You have to think about currency risks. You have to think about governance concerns. But for us to own DBS, which is Development Bank of Singapore, I mean, DBS is literally called the Fort Knox of Asia. It is one of the best managed, best run, most conservatively capitalized companies in the world. Why the hell should that be trading at a discount? Because it happens to be headquartered in one of the best economies, most well regulated countries, most conservatively managed countries on earth. Should trade at a premium, not a discount. So we own banks in Switzerland, we own banks in Scandinavia, Norway, and Denmark, and we own banks in Singapore because we don't understand why they should trade at a discount, given those are all currencies we like, regulatory environments we like, monetary and government systems we trust. So, subject to the caveats that, were implicit in your question, we absolutely think that is a disconnect that has opportunity and that investors should be looking and allocating more to global and international. We'd point out last year, I think, was the first year in decades where international outperformed a bit, and we would
That's right.
expect that to continue. We love what we own internationally.
Hey, Chris, I have one last question, and I guess it would be in regards to any exposure that you have in China. So, linking back to that conversation we had earlier, which I'm just going to call morality of profits, and how businesses that don't take care of their customers, et cetera, are ultimately punished in the market. I mean, if you're a polluter, eventually you'll pay the price for that over the long term. But those arguments are really dependent on defendable property rights. And so, how do you get comfortable with autocracy risk in different countries? Or how are you comfortable investing, deploying capital in China? How should we think
Yeah.
about that?
Well, of course, to use a phrase from Tom Gaynor, what matters a lot is dosage, how you size these positions. Charlie Munger said at the Berkshire meeting a couple of years ago that he was willing to take a bit of governance risk in exchange for owning some of the best companies in the best businesses he's ever seen at such low valuations. So, what I would say is, Lauren, over our lifetime, there is no economic miracle like China. We were, cleaning our plates or sending food to the starving children in China when we were kids. China's record of lifting people out of poverty is, you would be crazy not to define that as one of the great human rights achievements
Mhm.
of the modern era. 500 million, 800 million people lifted out of starvation. And the government there over that period of time has been run with enormous pragmatism, with very, very broad based support of the people who remember their grandparents eating dirt. And so I always tell people before they get overly critical, go to China, spend time there. That record of pragmatism and of gradual opening certainly has suffered a setback in recent years. The recent COVID policies seemed highly irrational, and the growing focus of power in a single individual has been a big change from the paths that China was on. However, when we look at companies like Tencent, I'll use what I'll call the sort of the tech leaders in China. They have gone through a wave of re-regulation that seems by and large pretty rational. It hasn't seemed arbitrary. I always joke that if you look at Google's income statement, there is a line on the income statement called fines paid to the EU. And it's there every damn year, billions and billions and billions of dollars every year. I look at banking fines paid here. So, the wave of re-regulation of technology, we're probably in the second inning of it in the US, and China may have completed that wave. We'll see. So, owning a bank in Singapore that is different than owning a company like Tencent in China. But we would say these have been incredibly well managed, incredibly profitable entrepreneurial companies. And by and large, the regulatory environment has been rational there. Alibaba's getting set back on trying to create the largest financial services company outside of the banking system. Well,
Mhm.
most countries are protective of their banking system. So we are not apologists for China. I would not want my family, if I could choose to be in the US or China, I pick the US.
Mhm.
I point out more that China has lifted people out of poverty, has dramatically improved their lives, and that maybe the better comparison to where China is in its economic history is where we were in 1900. And if we were to look at our record of human rights and worker rights and so on back then, obviously it was we had a record that was built with things from which we greatly, greatly improved. And going
Mhm.
back to your early quote on Ben Franklin, I think it was Scott who was quoting Ben Franklin, it's hard for an empty sack to stand upright. I think that the growing prosperity is the first human right in China, and in a way, the most important, the basic human needs being met. And for 2,000 years, if you could have been born anywhere on earth, picking China for 18 of the last 20 centuries would have been a rational choice because you didn't have a lot of freedom as I'll say a peasant in China, but you
Mhm.
had a lot of safety. And at a time when the rest of the world had massive starvation and enormous war and conflict and genocides and so on, China had been a fairly stable country for almost 18 centuries, and a relatively prosperous one, perhaps the most prosperous on earth, if you were to look at the standard of living of the average citizen. So it's a they certainly are going to be our rival. I would rather and hope and pray that they will be our rival, not our enemy, and that we will find ways to coexist with China. But if China deteriorates, if they invade Taiwan, if there was blood in the streets and people being, we would absolutely reconsider our investments overnight. So it's an important investment area for us, but dosage is the key given all those caveats.
Yeah, I like that answer a lot. Well, I'm gonna take some of the heat off of you and get to some easy questions. What are you reading right now, and do you have any recommendations for the rest of us?
Well, it's funny. I read 2 books last year that were so spectacularly good and are absolute opposites, except that they're both short. And I'll begin with the one that may be well known to your listeners. When I first read it, I liked it so much that I literally called the publisher and we ordered 10,000 copies to
Oh,
send out to our clients. It was the most useful financial book I've read in decades, and it was The Psychology of Money
I knew
by
you were
Morgan
gonna say
Housel.
that.
What a fabulous human being,
I
and
recommend that book too. We gave it out for Christmas. I recommend it to all young people. I think you said that you paid, or I've read or heard.
you're right, I paid
You
my children, my godchildren, my nieces and nephews, I bribed them to read it, because I was so convinced it will make their life go better, and not as, because of its investing secrets, but because of its value system that's implicit in it,
Mhm.
and of course, I did not know Morgan before I read the book and have since gotten to know him, and he is just a tremendous exemplar. And so I always put that. But now I'm going to put one that I bet you haven't read.
Mhm.
And I think that it is going to be important over our lifetimes to try to understand, or for me, I'll say, but I do think the societal implications will come to understand quantum mechanics and how that world has evolved, what quantum computing could mean, what it even is. And it is so difficult a topic. And last year, I found a small book that is a novel, but it tells the sort of fictionalized biography of Heisenberg. and his development of the mathematics of quantum mechanics.
Mhm.
And as a non-mathematician, what I love is it really tells it as biography. And the book is called When We Cease to Understand the World. When We Cease to Understand the World. And it is very, very disturbing and in its way, very beautiful and sort of breathtaking. But it is a book of general interest. Anybody can read it. You're not going to be thrown into, probability theory and quantum, deep quantum mechanics, but you will understand what it meant to the minds of like Schrodinger and Heisenberg and Einstein and Niels Bohr and all of them. And it's just an incredible read.
Well, I will read it. It will end up on my list and I will read it this year. I have big ambitions for 2023 to grow and read more, connect more with people. So that will certainly become one of my goals. What my last question for you, and I ask this of all guests, I'm sure you get this question a lot, is simply what advice would you give a young investor today?
Well, try to get smarter. I'm amazed at how Charlie Munger's model of trying to develop a lattice work of mental models to understand the big ideas in different disciplines, how useful that is, not just as an investor, but in your life. It's so much more interesting. And I think I'm often discouraged by how narrow a lot of investors are. And I think that it hurts them as investors, but I also think that it hurts them as human beings and citizens not to be more generally curious. So what I would say is for all of the time you spend studying businesses, reading annual reports, reading 10Ks, reading 10Qs, spend some time studying psychology, science, history, biography, studying the world that you live in because you only get one lifetime and investing is so fascinating as a subset of worldly wisdom. It's something that allows you to have broad interests. But
Mhm.
I think that to be given the opportunity to have this breadth of interest and not take advantage of it is a shortcoming that would be my advice to overcome that shortcoming. Have insatiable curiosity.
Yeah, that's really great advice. Well, Chris, you have been a wonderful guest. I have enjoyed this conversation so much. I could talk to you for hours, but I know you have better things to do. Where can my listeners go to learn more about Davis Advisors and your work?
Well, I have our client team is run, believe it or not, by my oldest friend. We've been partners for 25 years, but we were also baptized together as infants
Oh my
Oh,
in the
gosh.
wow.
same day assembly line fashion. So he has built our website at davisadvisors.com really to focus on investor wisdom. It's not a marketing page. It's really links to articles, links to things we've done with Morgan and other things like that. So if anybody wants more of that, I would recommend going there. He's done a wonderful job on that.
Awesome. Well, thank you, Chris. And that concludes the podcast today. Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.